Hello and welcome to the Investor Lab, the auditory epicenter for passionate people seeking a life of freedom, choice and abundance. My name is Gabby Lee Billing for those of you playing at home, and on today's show we are doing something a little bit different. In case you can't tell, I am not Mr. Goose McGrath. No, I have given Goose the week off this week. He's allowed a little bit of downtime. And on today's episode, we are doing a bit of a recap on the last 12 months. So in the last 12 months, we've actually released 51 episodes of absolute gold, if I do say so myself. The last 12 months, 51 episodes, and there's been a cover of, market updates, investing strategy, amazing interviews, and you even got to meet some of our team. And so what we've done is we've really boiled it down to the top 10 episodes over the last 12 months. And so this is top 10 favorites, top 10 best, top 10 listener choice. We've actually reached out to you guys and asked, what episodes did you actually get the most amount of impact from this year? And so if you've loved the show and you feel like you have maybe just blown through the last year, I think a lot of us have, and really just kind of look back and go, what the hell happened this year? What did we talk about on the show? This is the episode for you to go back and listen to, get a refresher on the top 10 concepts and people that we interviewed, and either get a refresher on what the hell happened, or you'll even pick up some more nuggets of gold from those episodes. Or if you've got a friend that you know who would really love the show, but maybe just kind of sending them the podcast link and saying, hey guys, just check out all these episodes. This is the episode to share because it gives them a good real taster of what we've covered this year and the kind of stuff that we do. So this is the episode to share. And if you love the show yourself, if you love this episode, as always, feel free to send us an email, hello@dashdot.com.au. You know I love hearing your feedback. I love receiving these emails. I love hearing what you think we should be improved, what your favorite takeaways were, what are some things that you took away and really started to implement yourself, and how it's improved your lives. I love hearing all of these stories. And without further ado, let's get into it. Thank you so much for the last 12 months. Thank you for listening to this show. Thank you for showing up and listening to Goose and I in your ear holes every week. It's amazing to be connected with you all and to be able to share some knowledge and to be able to really impact you. So without further ado, I'll see you on the inside.
If you can understand that the ideal time to buy is earlier in the cycle than when it's a hotspot, don't buy when it's a hotspot. And some easy identification points to know whether it's already too late. Are there multiple offers being put on properties? That's a really simple one, right? If you're trying to buy a property and the real estate agents are saying, well, we're going to multi-offer, i.e., I won't accept your offer straight away. I'm going to accept 10 different offers and then we're going to analyze them. You're already too late. Yep. Right now,
agent sentiment is such a good qualitative measurement.
Yeah, totally. Agent sentiment is a huge one. Yep. Now, interesting, and so there's all these kind of signs. If suddenly it's gone from 2 or 3 people going to an open home to 60 people going to an open home, you're too late, right? If you see people are paying, 30, 40, 50% above the asking price, you're already too late. These are all signs that you're already too late. And another really interesting sign is if the yields have previously been 6% and then they're down below 5%, you are already too late. You've got to look at the yield cycle as well relative to median house prices. Because you're going to say something?
I was just going back to that point you said about, if you're looking in a location and there's like 2 people at an open home or whatever, and then suddenly there's 60 people, that's one of the signs for us as a business to exit that market. What about other people who are not us and do not have a business doing this? What do people do then? Like if it's like, okay, I've got this sign now that it's probably heating up and I've probably missed the window. What do I do?
It's a good question, right? Because even in markets that have become overheated, we continue to look. So, for example, the Adelaide market is broadly speaking, we haven't bought there in a little while, but we continue to look. Because if you know that an area has good fundamentals, then it doesn't necessarily make sense to just go and try and find somewhere where there's no one else buying. right? That can't be the metric for making the decision.
Yeah.
Don't just go somewhere because it's quiet and go, oh yeah, I think I'm beating the crowd, because that's not necessarily the way to do it either. And to that point, you know, like I've had a lot of people ask me about Brisbane. Quite publicly, I'll state that you're probably 2 years too late. But that does not mean that Brisbane is not going to grow.
Yeah.
It doesn't mean Brisbane is not going to grow. I think Brisbane's going to do pretty well over the next few years. And so you could buy now and you could get growth. But it depends on what you're investing for and where you're at in your investor cycle. Because if you're getting yields below 5%, then you're probably not going to be cash flow positive. And so your holding costs are probably going to be significant. It's probably going to corrode your overall borrowing capacity. And you're also probably going to be paying over what the intrinsic value of the property is worth. Okay, so there's a few different factors in there. So how can you think about it if you are in that kind of a market? Well, one, you should do a bit of analysis to go, okay, is this the right market to be in, and where is it in the cycle? You know, how overheated is it? How far do I think it's got to run, and why? And one way to think about doing that would be to look at all the infrastructure projects, jobs growth, longevity plans, council plans, population growth forecasts, heaps of other stuff, and go, okay, is this a short-term thing or is this a long-term thing? And then you should also potentially think about looking in other markets. Now, again, it's not to say that buying in a area that is booming is a bad thing, but you need to be a bit more opportunistic about it. So sometimes you can find really good deals in hot markets. You've got to be very quick when they come up, though. Yeah, obviously. But it's not to say you can't buy effectively. It's just less common, and you actually have a way better opportunity to get better properties that are in a better position for growth if you can get a little bit ahead of the crowds. I'm not sure if I answered your question though.
No, you did. I'm just thinking. So, as always, it generally comes down to what are you trying to achieve? Yeah, totally. It comes down to where you are at in your journey and what this next
where you're at in your cycle.
Yeah, where were you? What your next purchase needs to be.
Let's loop back to something that we started touching on earlier, and that is the fact that principal payments are profits, not cost of debt. A lot of people say, "Oh, yes, but my mortgage repayments are so high. I'm paying principal and interest, and then it's costing me so much." It's actually the interest component is the cost of debt.
Yep.
The principal component, that's profit, right? Because that is equity that you are putting back into the asset, right? That is cash flow that you are sacrificing in order to put money onto the balance sheet. Simple as that. So that is your owned equity. So what you're essentially saying, if you had, let me use the example of the $500,000 property yielding at 6.2% again. Let's assume an interest rate of 3% just to have a baseline. If it was interest only and we were not paying any principal down in year one, based on some preordained property management rates and insurance and all of this kind of stuff, the net cash flow would be $11,300 thereabouts, right? Now, if we decided to pay principal as well, the net cash would be about $3,000. So let's just say $11,000 minus $3,000, right? That's $8,000 of cash that we've decided to put back into the asset. So that's pure profit. Right? There's no other way to view that. And so a lot of people get caught up in the cost of debt and they think, oh, it's costing me all this money to pay down these assets, when in actuality, what you're doing is you're banking profits and you're just putting those profits aside in the asset. I think that's a real headbender for people to get their head around, because if you really think about it, you know, the interest component on your investment is the tax deductible component, because that's an operating cost of your real estate business. And the principal payment is just pure profit. Okay, so then you can choose, do you want your profits to be in free cash flow, or do you want your profits to be on the balance sheet as equity? Think about that.
Yeah, it's really cool. It's actually, I was thinking about how funny it is that how frequently we refer to like balance sheets and profit and loss statements to try and explain and wrap our heads around these kind of concepts. And we talk about it quite a lot between us. But for all the accountants in the room, you can picture like a balance sheet. There's like assets minus liabilities. Assets equals liabilities plus equity. So your liability would be your loan, so your debt that you have with the bank, so that when you're paying down the principal, you're basically reducing that loan, which means that your equity, your owner's equity portion is increasing. So that's kind of what you mean when you say paying down the principal is actually just profits, because it's your equity that's increasing.
Totally. And if we think about this from a business perspective as well, which is what we should, of course, be doing because we are, we're serious property investors and real estate investing is a business enterprise.
Yep.
If we think about it like that, so there's different ways to run a business too. So you can have high growth, high equity businesses. They got very low cash flow. They're typically the ones that you need to go and raise a lot of capital for, right? Mm-hmm. They're typically ones where you need to get outside investment, do capital raises and all of that kind of stuff. And you might have a lot of equity on the balance sheet, but no operating cash flow. So it's this equation that happens in real time. Like you've got different types of businesses will have different financial structures. The key to having a healthy business that can grow effectively without having to seek outside investment and diluting your equity portions, and in other words, a JV is probably another way to think about that in real estate. Hey, I don't have enough cash flow to fund this. I need somebody else to come into the deal as well. Can you give me some capital? That would be a JV, right? So, but in business, we'd call that an equity partner or something to that effect. Mm-hmm. But it's the same kind of thing. So we can then choose how do we want to operate our real estate business. Are we generating enough equity already? Are we comfortable with the amount of cash flow we have within and outside the asset? Should we have a higher amount of cash flow? Should we keep our profits liquid by having an interest only loan? That's one way to think about it, keeping my profits liquid. Or if you want to reduce the total cost of debt over the macro, are you better off to pay that down? There's all these different ways to think about it, but understanding that principal payments are not the cost of debt, right? That's you banking profits and stockpiling. That's putting money under the mattress is the easiest way to think about it. Now, what happens though, of course, as you reduce your debt, right? So as you bank profits and put them into the asset, you're reducing the amount of borrowed equity. Okay, so you're reducing the amount of debt you have. You obviously decrease the cost of debt because you have less debt to equity.
Yes.
All right. And so what that can do over the macro is increase the cash flow. Okay. So you've got to play short game and long game with this. But if you can understand that the principle is not I'm not paying back, I'm not just giving money to the bank. You're actually giving money to yourself, and that's pure profits. And if you were to look at your real estate investment using, generally accepted accounting principles, GAAP, you would see that would ring true for you too. I think the more that we can start to get our heads around these kind of numbers and start to think in these kind of terms, I think we can make more empowered decisions. What do you think?
Let's just head straight to debt. How does debt play a role in this, and how do you think about it? Like, as I said, it's how you think about it. Is my aim that the end game I should have no debt? Is it wrong or bad or not the greatest idea to have 50% debt when I'm 80? Is that even an issue?
You want the answer?
Definitely.
It depends. So here's the thing, right? It depends. So here's the thing. Here's the way to, let's talk about how to think about debt because every single person is going to be different. It's all going to depend on your risk profile. I am absolutely not going to sit here and say, well, everyone should have 50% loan to value ratio because, hey, man, I don't know. It depends. If you want a higher...
I want to caveat this, though. I had a conversation with a broker who I will not name. It's not the broker I use if you are listening to me. You were good about this. But he said to me, legitimately, you would not be wanting to head into he goes, you shouldn't be carrying any debt after 65. He said, your whole plan should be working. And I'm like, I don't think that's right.
That's maybe. No. You cannot live in those levels of absolutes. What happens if someone's listening to this and they're 60 and haven't built a wealth plan? They're going to get it. Guess what? Go carry some debt. It's not that. Debt is not bad. There's nothing wrong with debt. It's all about managing risk. So, if you want a higher return on investment, if you're optimizing for return on investment, more leverage is better. Let's take this to an extreme. If you could have a portfolio, let's just simplify it, at one house, if you bought one house at 100% LVR, right, or let's just say 99% LVR, okay, and it's a $500,000 house and you bought it at 99% LVR, so you've only got 1% of debt, of equity in the property, and all of the rest of it is debt. And then, so you've got, let's say, $5,000 in the deal, and then it goes up by 10%.
All right, so it's made $50,000 of operating profit. Now, just like all profits in any business, to get that profit out, you're going to need to pay tax on it, okay? And this scenario is called capital gains tax. But it doesn't matter, even if you sell shares, you're going to pay capital gains tax. Everyone goes, oh, so what about the selling costs? You're going to realize selling costs or liquidation costs regardless of how you access your capital. So I think it's just a completely moot point. Anyway, moving on from that little rant. So, if you've made $50,000 of profit out of 10% growth and you've only put $5,000 in it, I haven't got the maths on that, but what's that? What's that in terms of return on investment? It's like a 1,000%, 10x? Well, it's 10x, right? So it's 1,000%. That is a 1,000% return on investment. So you say to someone like, do you want 1,000% return on investment? Awesome. Go and find someone who'll give you a 100% LVR loan. They exist, right?
They do exist.
They
Scary,
exist.
but they do.
Yeah, go and get a 100% LVR loan and go buy a house, right? And just like if it goes up, dude, crushing it on an ROI basis, right? That's awesome. But it's pretty high risk, right? Let's be honest, right? If you are leveraged that high, it is higher risk. Now, some people have got different risk tolerances, and it's going to depend on where you are in your journey as well. So, for example, if let's just take an example that if you bought a 95%, I actually did this calculation the other day. I'm trying to remember the price point that I did it at. I think I did a 95% LVR on a $300,000 property on an average growth rate of 5% a year, and it was on interest only at 6% yield, right? And so I did all these that was the basis of the test. I just wanted to kind of have a calculation on the ROI. And I said if it grew at just 5% a year, so no moonshot growth, no double-digit years, nothing like that, just 5% a year, pretty average. Now, and then I capitalized the growth and the cash flow together, and then I said, what if we sold it after 5 years? Because you get an interest-only period for 5 years, right? So I said, what if we just got one $300,000 property at 95% LVR, it grew at 5% a year, it was 6% yield, and it was on interest-only, and at 4 years and 11 months, we sold it. So then I factored in capital gains tax, I factored in selling costs, and then I said, okay, what would be the net return versus the capital injected? Now, I can't remember the exact numbers in front of me, but it was something like over the 5 year period would be a 288% return on investment, which is an annual rate of return of 60%, roughly, nearly.
We'll have to get someone to fact check our maths in this conversation. If anyone's listening, of course, quotable numbers here.
Yeah, totally. But I'll actually maybe record something and stick it in the show notes on this because it's really interesting. On a return on investment basis, it's quite good. But what you asked about was debt and what's the end game. Is that the way you should think about optimizing your portfolio forever? Well, no, probably not, because that's not going to be optimizing for cash flow over the long term. So as you start to move into different phases in your portfolio, you're going to want to be considering what is the best based on your life plan and life situation.
Okay, so to reiterate that around, okay, because this is the part where it's like, I want to make sure we answer this, because this has been literally a question I've been thinking. I'm 32 today. I've got a good working career ahead of me. I enjoy my business and I want to keep doing it.
Yeah.
My earning potential across this time is solid. Well, I think it is.
Yeah.
Probably people out there smashing it, but when I look at that, I go, okay, well, if I'm going to take on 80% LVRs or anything right now, I'm not as concerned because I can look down the road and say, well, there's years of good earning ahead of me, potentially. And I'm comfortable with that because I can pay these things off or raise capital or do what I has. How does that change for the person that's, let's say, 60 then? Because they don't have that, or 62, we'll use 30-year gap. Do you change the way you think about debt and lending?
I don't want to sound too ambiguous, but it entirely depends, because what you actually need to consider is not the debt. Don't think about the debt. The debt is just a tool. Like, the banks are saying, like, we're happy to secure against an asset at a certain basis. Now, 80% LVR, you got to think about that. How bad would that property need to go for it to go completely bad, right? What would need to happen if you had an 80% LVR? So the bank owns 80%, you own 20%. For that property to go bad, as in like for that to go into negative equity where it's potential to get foreclosed on and it's no good, right? Well, for it to go bad, it'd need to fall in value by 20%, right? Now that has happened in Australia. You can look at places like Perth and find examples of markets that have done that. But that's where you need to start thinking about your risk and exposure. Like, what are the drivers in the marketplace and all of that kind of stuff. You've got to think about your exposure risk. Would I, if I was 65 years old, want to have a $10 million property portfolio leveraged at 80%? Probably not, but I'd also say that's a little bit down to personal preference as well, right? Because here's the thing that you need to really be thinking about. You need to be thinking not so much about like, oh, what's my debt position? It's what's my risk exposure? What is my cash flow? How many moving parts do I want in my business, i.e. my property portfolio, all of that kind of stuff. Because there's a couple of different ways to think about it, right? If you owned less assets and had zero debt, they would be way higher cash flow. So what I spoke about a moment ago was optimizing for return on investment. Typically, when you optimize for return on investment, you're not optimizing for cash flow. That is not a good way to go for cash flow, because the more debt you have, the more expenses you have. The debt is
you got to pay more interest.
Totally. The debt is the most expensive part of the operating costs of your real estate empire, right? Your real estate business. So then you got to think about, well, what am I optimizing for? And we've used that term a lot on these episodes. I think it's so critical to think about that in so many different ways, because if you're optimizing for cash flow and you have more capital, then it kind of like it changes the game, because you could, for example, let's say you're a cash buyer and you know, say you've got $1 million in cash and you go and buy a $1 million property that is yielding at 4%. Now, I'm not going to do the maths on that because I don't know it, right? But that's going to produce a significant amount of cash flow. Why? Because you've got no debt.
Yeah, well, $1 million property, 4% would be 40 grand a year.
Yeah, minus things like property management rates and everything like that. So there'd be a little bit of a net difference.
Call it 30. We'll go 30
yeah,
then.
Okay, cool. Awesome. Right. And so if you had the ability to do that, you would have 30 grand cash flow. Now, if you said to someone, do you want to buy $1 million property that has $30,000 cash flow? Most people are like, oh my God, it sounds great. But what you're really talking about is what's the debt equation in that property. And this is how I think that we need to change the way we think about debt and what the end game is. Because a lot of people will say, here's the strategy, right? You buy 2 properties every year, and then I've seen this played out before. It was like buy 2 properties every year for 10 years. Or maybe it's 1 property every year for 10 years, and then get to year 10 and then sell half and pay down the other 5, and then you have 5 that give you the cash flow you need for life, right?
I'm so happy you said that. That's literally the next question I had on my notes. So if
really?
was talking, yeah, because this is the next period. So we're talking about, okay, as you get older, the amount of debt associated to return versus cash flow and risk, which I think is the big one there. But then the next one I go to is even if you're that same person, and we'll use an example, pretend you've got 10 $1 million properties, and you've bought 1 a year for 10 years. Is the aim then to give it time to pay itself down from rents?
So you say emotional and financial fortitude quite a bit. What do you mean by that, and how does that affect asset allocation?
Well, financial fortitude essentially is, you know, what is your financial IQ as well as your financial capacity, right?
Mm-hmm.
Because you can have a lot of money, but also have a low financial IQ. A situation like that might be, let's just say that you've never had any money and you've never really, you know, money's never been a part of your life. You've never been a good saver or anything like that. But all of a sudden you get a big inheritance and you've got $1 million. You know, you might not have a very high FIQ, right? FQ. So you've got to think about, okay, what actually is do you understand things like, you know, capital allocation ratios, yields, you know, cash on cash rate. Like, what's your understanding of the financial side of the transaction? Or is it just like, all right, buy houses, right? So it's really about assessing, you know, financial understanding, financial fitness. Like, have you got a track record of being able to manage money properly, all that kind of stuff. That's kind of the financial fortitude side of things. It's not just about money, it's about your understanding of money as well. That's a big one.
Cool.
And then you've got emotional fortitude, right? So some people are more resilient than others. Some people have a higher risk tolerance than others. Some people like things when they're fast and fast paced, and other people like things when they're slow and easy. So if someone has a low tolerance for risk, doesn't want a lot of complexity, maybe has never gone on the journey before, is a little bit anxious about what's involved in property and how much, you know, and oh my God, how does all this work and how do property managers work? And, you know, if there's a degree of stress involved, I would say that's a low emotional fortitude, right? And that's okay because everyone starts somewhere, right? And then that's all good, right? So someone who has got a degree of stress
around the process, I would say it's much more important to focus on assets which are not going to exacerbate that stress, right? Because you may buy a great property, but if you get to the other end of it and you've had this, damaging, challenging, stressful experience where you're emotionally scarred because it was all too fast, too quick, too complex, too hard, the likelihood is you're not going to buy any more properties, well, certainly not for a long time. And then that's actually going to move you further away from your goal, not closer to it. Mm-hmm. And so just in the same way that, I might have a goal to run a marathon, but if I try and run a marathon, if I just go, great, all right, I've decided I'm going to run a marathon and then go and try and run 40, whatever Ks it is, I'm more likely to cause myself an injury. And also even if I did manage to complete it, I'm going to be in pain and I'm going to be hurting and I'm going to be like, screw this. I'm never running again. Running sucks. This is the worst thing I've ever done. Versus if I said, okay, cool, I would like to be able to run a marathon in 12 months. So what I'm going to do today is I'm going to start by running 1 kilometer, right? And then slowly building up to that, I would probably find that I have more enjoyment, more sense of achievement, and more sense of fulfillment along the way. And I think that this is the way to think about it. It's not about just going, how fast can I get into the highest ROI deal? It's about going, okay, what is actually going to satisfy me along the way? Because all of this is about the journey. The goal is cool, right? But the goal is not going to happen really, really fast. None of this is get rich quick kind of stuff. And so if you take let's say a 10-year time horizon with the whole thing, this is going to have to be something that you're going to enjoy. And you've got to think about that, not just about money as well. Does that kind of make sense?
It does. And I think it's way more important than people give it credit, like the role of emotions in property in this whole kind of world, because it really starts with self-awareness, right? It starts with like taking stock of not just literally like asset wise, where are you at, and resources, but where am I at in terms of like the realm of my life and what else do I have going on, and being really honest and clear with yourself about what I can take on right now. So if we go back to that example of someone who's got, maybe a lot of equity, but not a lot of income, and they're kind of thinking that I'll go and do some kind of chunk deal, or they might do might try to do a full renovation interstate, like they'll do it borderlessly and not go there and try and manage that on top of their whole life, what is currently happening. And so we actually see this happen to people where they will take that on as their first investment, kind of their first step into property investing. And that's the first thing that they try to do, because again, it's a good strategy and works for some people, but they're not thinking about how it fits into their whole life. And so they go through that experience and it is so stressful. It is so damaging just from the added stress that you end up leaving that experience. You might have a financial reward off the back of it when you actually finally finish it, but you are emotionally scarred from that experience, and you automatically make the assumption, well, this isn't for me. And you jump to property investing is really hard because you've accidentally done the wrong strategy for where you're at emotionally at that point in time.
Totally. It's kind of like dieting, right? Like if someone wants to go on a diet and, let's say they're like, hey, I'm too fat and I want to go on a diet. And then they go to an extreme and they go, I can only eat grapefruits. And they might lose a whole bunch of weight really, really fast, but it's not, it's not going to be something they're going to be able to stick with, and they're going to bounce back and they're going to get back to where they were. Right. Yeah. And so it's about going, okay, what's going to be sustainable? Like what's the sustainability context with this whole thing, right? It's a marathon, not a sprint, right? Yep. And to that degree, there's this really interesting dichotomy though. It's like, it's cool for it to take some time. So let's don't get too caught up in, should this be a 6% yield or a 6.2% yield? Like, given the time horizon, it doesn't really matter. Like, as long as you don't run out of debt and capital, and as long as you're managing your capital to debt ratios along the way and your debt to income ratios along the way, you're all good. Like, you just keep on motoring, you just keep on humming. Which is in fact why we have such a high volume of clients that are buying 3 to 5 properties a year, because we pay really close attention to, okay, like what's the availability of debt and how we're going to manage that, right? So you can it's all good. Just focus on those things and you'll keep ticking through.
If we're saying that on the one hand there's pent up demand, that's not going to be all applied in the same area, because
as we all are aware, and as you've already illustrated a couple of times, people are leaving places like Sydney and Melbourne in droves. At the same time, property prices in Sydney and Melbourne are going through the roof, right? So it's a bit of a paradox there for sure. But people are moving, and they're moving for specific reasons. Now, I know you're a big proponent of your big idea of the exodus to affordable lifestyle. I would push this a little further and add another vector to that. And we often talk about the holy trinity being cash flow positive properties in high growth areas with value add potential. But I would say the holy trinity of location selection at the moment would come down to three factors: affordability, lifestyle, and jobs. And so I would suggest that is driving the demand centers at the moment, and that is going to be underpinning the areas that are going to succeed, not just on a sugar high basis, but also to have longevity over the next decade.
Well, it's a very good point, and I think the point needs to be made again and again and again to people that, yes, that there is this big trend. We call it the exodus to affordable lifestyle. People are moving to the smaller cities. They're moving to the peripheral of the big cities, and they're moving to country areas. But particularly if you're an investor, it's really important to choose your locations well, taking a long-term view, because I think there's too many people buying willy-nilly, thinking we can buy anywhere and get growth, and that may be true in the short term, but it won't be true in the long term. There's got to be intrinsic drivers of growth in evidence if you're going to target a particular location, not just because it's maybe a sexy coastal town and the prices appear cheap relative to where you're currently sitting. It needs to have some substance. It can't be a one-horse economy with just tourism or just agriculture. It needs to have more substance.
Well, let me pose a challenge to that, right? Because I would argue that to some degree, even a small coastal town which purely only has one of the three core elements, maybe it's only got lifestyle, maybe it's got two, lifestyle and affordability. It's cheap to live there and it's right near the beach. I can think of plenty of places like that, particularly on Queensland's coasts, maybe places around the Whitsundays and stuff like that, where there's smaller regional areas, great places to live. Could you argue that even without specific infrastructure, jobs, things like that there could be sustainable market growth there because of the advancements and developments in technology and the shift to remote work and all of that kind of stuff? Do you think think that that's a misplaced understanding?
No, I think you could make that argument. And you see, one of the problems we have at the moment is that we are in unprecedented times, and some of the forces in play are quite new. There's never been a situation like this that we can go back to and compare as a precedent. And the fact you've just raised is one of those ones. It could well be, and only time will tell. What we know to be true up to this point is that locations that are very narrow and fragile economy, just tourism, for example, tend not to have sustainable long-term growth. And it's only when places like the Sunshine Coast broaden their economy, have a big infrastructure spend, that the growth starts to become more substantial and more sustainable. But if this trend continues, with people are just moving to places because of lifestyle, because of the ability to work remotely, then it may turn the dominant paradigm on its side a little bit, and we'll have to start rethinking some of these old beliefs. But I can't really answer it. I don't think anyone can until we've had a few more years of it. I think the trend's going to continue because media's tended to portray it as a response to COVID, but you and I know that's not true. It's been going on for longer, and COVID has just enhanced and exacerbated it. But it will continue because it's about technology and lifestyle. And we note that, for example, LinkedIn put out some material recently showing that more and more employers who use their platform to advertise jobs are actually proactively offering, as part of the package, the ability to work remotely. Because for some employers, and it doesn't work for everybody, but for some, it works at both ends because the employers can potentially save a lot of money on their office costs if they have fewer people actually in-house working. So, yeah, places that don't have a lot of substance to the economy may actually have just this ongoing demand from people making that shift.
Yeah, it's an interesting one because actually we've seen that even within our team members with the development of better connectivity and Wi-Fi and satellite internet and all of this kind of stuff. One of our core team leaders within our business, he is actually traveling around the country in his caravan, working from his laptop as he literally travels around Australia. Currently, he's up around Broome and just enjoying it. And he's able to do that because of the transformation of the way that we work. But I'd also say there's another really interesting factor around all of this as well, around this kind of movement of people. Whereas a lot of people once, particularly with fly in, fly out jobs, which is probably going to lead into the next point about resources sector, with fly in, fly out jobs, often people were able to live where they wanted to live and would just fly to work and do their 2 weeks on, 2 weeks off, or whatever the rolling roster may be. However, with lockdown changes, that's shifted as well. And I think that's an interesting and possibly unexplored paradigm around why some markets might be driving harder than others at the moment, particularly ones that have got at least a portion of their economy which is related to the resources sector. I mean, I'm thinking of places potentially like, the Hunter Valley, potentially places in Queensland and Western Australia where, it's no longer practical. And in fact, businesses won't even allow employees to live interstate because of the risk of them getting shut out and losing half their workforce.
What I think is good to talk about now, because it's like people are like, okay, cool, got it, great. I need to set some rules and I need to set the right cadence. But what is the right cadence and how should I think about doing that? And more specifically, how can I get more organized? Now, this comes down to basically treating your portfolio like a business, right? Now, in any business, actually, it's probably a long bow to draw. I would say most intelligent businesses would do a quarterly planning session. They would do a quarterly review. How did we perform over the last quarter? And then a quarterly forward planning. What are our goals, KPIs, and objectives for the next quarter, right?
Mm-hmm. That can be called a review preview.
Yeah, a review preview, right? Yep. And I believe that all property investors should do a quarterly review preview of their portfolio. Now, the reason for that is it's going to give you a regular check-in point to assess where you're currently at. Now, within the context of saying, well, you should go as fast as you can within the investment rules of your portfolio and, of course, within the financial, considerations of your family and life and all of that kind of stuff, then some of the ways you can do that, because a lot of people are like, well, is one a year the right cadence? Should it be one every month? Should it be one every 6 months or whatever? The point is that you should consistently review the health of your portfolio, because you might say, oh, well, I don't know, maybe it's like once every year, whereas in actuality, maybe your properties are growing and performing really well, and maybe you could go every 3 months, for example. So I tend to think that quarterly is a really good check-in point. And so what you can do every quarter is you can speak to your broker and just ask, hey, can you order some valuations for the properties that I've got? I want to see if I've got any equity and if I can go again. Now, that's a good step. And the way to build consistency with that is to set a reminder in your calendar, for example, every 3 months, contact the broker, right? Mm-hmm. And so you'll then have an alert. So you don't even need to think about it. It could be on the 1st of July, 1st of September, or whatever, to go, hey, cool, it's time to reach out to the broker. Hey, broker, it's me again. Just want to check in. Have I got any equity in these properties? Want to know if I can go again, right? Now, if you do that, maybe you don't at that point, but maybe you're really close and you might say, okay, cool, I'll check in again in a month, right? Or 2 months. Otherwise, it might just be like, okay, great, back to you again next quarter, move on. Mm-hmm. Now, there's a few tactical things that I want to throw in here as well to help manage this a little bit better, because some people also don't really understand, like I think my properties are positive cash flow. It seems like there's money in the bank. Gets a little bit confusing and a little bit messy. Mm-hmm. So there are simple ways that you can help to manage this a little better. Like, so for example, you can get accounting and cash flow management systems like Xero, and there are a whole bunch of other ones probably simpler than Xero. Xero is an accounting platform that you can get, and you can put your properties into Xero like business units basically. Mm-hmm. And then you can set up things like Receipt Bank, and then you can spend, say, 1 hour a week or 2 hours a month or whatever needs to be done for your portfolio to go, okay, what are my cash inflows and what are my cash outflows? And that way you're going to be able to catch things in your portfolio like, oh, wait, hang on a second. I thought insurance was going to cost X, but it's actually costing X, or I had allowed this much for maintenance, but in actuality it's costing me more or less. And you'll be able to catch all that stuff early so you have a better head check on what's going on with your portfolio. Now, the reason that you want to do all of this is so that you're consistently in tune with the health of your portfolio, and then you're creating the right structure and system. So you might have, you could set up, the financial tracking systems using something like Receipt Bank or something like Xero. And again, there are plenty of other
tools out there that you could use to achieve a similar effect. And then you could just say, well, once a month, I'm going to review my cash inflows and my cash outflows, and I'm going to check in with my property manager or property managers once a month. Just you can dedicate 4 hours, one afternoon on a Friday, last Friday of every month could be, for example, where you ring around, you go, hey guys, just want to check in. How's everything going? How's everything with the tenants? Is there anything I need to know? Is there any outstanding items that you haven't sent through? What's the rental market looking like? When do you think we could put the rent up, etc. Right?
Mm-hmm.
All of that kind of stuff. And then check your cash inflows and cash outflows to know, okay, is this profitable or not? Am I producing more money than I'm using? If you do that as well as having a consistent, regular timing of like, okay, every 3 months I check in with the broker and go, hey, can I borrow again? What's going on? Like, can you do an assessment on my borrowing capacity? Has it gone up or gone down? Can I refinance any of the properties? Is there a better loan product for me? Is there some way that I can optimize my portfolio? Just doing that is going to give you a much better process-driven approach to your portfolio, which will likely end up with you buying, 2, 3, 4 properties every year for a long period of time, because you'll be approaching it with a different mindset and a different level of professionality.
Yeah, for sure. And I think the funny thing with this is that it's nowhere near as sexy as the time when you're going to buy a new property. This is the maintenance work. Like, this is the habits that actually help people to succeed in whatever they want to do. Like, it's the maintenance, the daily, weekly, monthly, quarterly habits that people take and stick to that actually help them to succeed in whatever they're trying to do. So it's not necessarily all the excitement those few months when you're buying a property that is moving you forward. Obviously, you're doing the action that will move you forward, but it's all the supporting activities that you do and stick to that will make sure that you are taking this seriously and taking it professionally. And so on the quarterly review as well, you can, if you have a good property manager, getting a quarterly, as you said, you can reach out to your broker to get an update on your borrowing capacity and a valuation on your properties to see on the asset and income side of things, where are you sitting there? But on the expenses side of things, you can work with your property manager as well to see if on a quarterly basis they can send you an export of all of the expenses that have come through that property as well. And so if you're using an accounting software like Xero or something, you can then match them and reconcile them and make sure that you know where all the money has gone. And from a daily, just general hygiene, businesses have separate bank accounts for the business, separate from the directors of the business. So the company itself owns a bank account or several where the money comes in and goes out, so that every transaction that's in that bank account is related to that business and not related to the directors. And so this is a really critical thing that I always advise people is set up at least one separate bank account for your property investment.
Preferably one bank account per property.
Yeah, preferably one bank account per property. So it just needs to be an everyday transaction account where all of your cash, all of your rental income goes into that account, and then all of your repayments and anything that any of your invoices that come in that you need to pay go out of that account. So you can really clearly see, is your cash balance going up or down? And if you're positive cash flow, it should consistently be going up. And you're always going to consistently have a real delineation between your accounts of what is actually related to each property, so that if you're doing it, because even if you do it on a quarterly basis, if you've got all of your transactions just going through your normal life account, you're going to have to go through every single transaction that you've ever made using your personal card in that 3 months. And that can be quite a few when maybe they're not really relevant to your portfolio. Whereas if you split it out into different bank accounts, you might have 10 transactions for the quarter, and you can easily get through that and have conversations with people about it. So that's just on a really general hygiene, have separate bank accounts if you can. And they're really easy to set up. You just contact your bank. You can do most of them online now. You just request open a new account. So it's definitely worth it.
And I love all of these conversations, right? Because it's multiple times a week talking with clients about what is the end goal, right? It's always start with the end in mind. It is, what are you trying to achieve in your life financially? What is going to fill your cup in the next 10, 15, 20, whatever the end goal timeline is. And how do we strategically work backwards from that and reverse engineer of, okay, what assets do you need to buy that are going to, exactly how you explained, they stack up and then you can leverage out and do into more cash flow, and building out these assets that are strategically designed to get you to that end goal, whether that's buy a dream home for $5 million, whether that's, replace my income in 5 years, whatever that goal is. And so this is how all of our client relationships start. It's about going, where do you want to be at the end? How do we need to plan your portfolio to get to that? Okay, what is the next asset that we need to buy? And then we help you go and find the best asset that's actually going to do that first piece.
Yeah, it's such a good point that you've raised there, Gabby, because a lot of people think that, okay, so we just go and buy heaps of properties. That's it. We just go and buy heaps of properties.
No.
Yeah. Interestingly, I had a conversation with a client of ours who we're actually in the process of going, well, how do we restructure the whole portfolio? They'd bought a bunch of properties before they came to us. Mm-hmm. And in actuality, they got the portfolio hasn't been structured correctly. And so what that actually means is that if they keep going in the way that they're going, based on their current savings rate and household income, they're not going to get to their destination. So what that means is they're not able to save a lot because they've got a young family, they've got all of that kind of stuff.
They're running out of gas.
Yeah, they're running out of gas. And so if they just keep leveraging, they've got a few residential properties, but if they just keep trying to leverage to get more capital, their cash flow is going to decrease, their borrowing capacity is going to decrease, and they're on a downward spiral. And so in that specific scenario, what we're looking at doing is selling off a large portion of the portfolio to then go and fund a higher cash flow asset. So they're starting from a higher yielding base so they don't run out of serviceability as much, and then repurposing the capital to be supported in that way. And all of this has to be thought about. If you're, no one should start investing if they don't know why they're investing. Just don't. Just go and do anything else, right?
Yeah.
Do literally anything else. But if you do know where you want to get to, you need to think what strategically and systematically are the processes going to be, or what types of properties do I need to buy in what order? How do I make sure I don't get stuck? What are the steps that I need to take to get from where I am now to where I want to be? And how do I make those decisions in the right way at the right time? And for a lot of people, it's going to be sort of slightly contrarian. They're going to need to reassess what their values are. Most people would say, yeah, look, I want to own my own home. And it's like, well, yeah, but would you want to, I don't know, if you're in Melbourne, would you want to own your own home in Caroline Springs, or would you prefer to own your own home in Brighton, right? So for example, right? And so you've really got to weigh up the short versus the long. And I think, weigh up not the risk versus reward, but short-term gain versus long-term gain. Mm-hmm. However, I don't think that needs to be some brutal compromise where you're like, okay, well, I'm just going to go and slave away and I'm going to live I'm going to make my life basically suck right now so that I can live a better life later. I don't think that that's true. I don't think that you have to, cut yourself down to the bone now in this, and hold up this destination that you're eventually going to get to if you do everything right. I think, why don't we aim to have it all? Why don't we have our cake and eat it too? Why don't we have fun along the way and also achieve great levels of prosperity and abundance and happiness? And, happiness is not a destination, it's a state of being. And I think that people need to think about what is going to make me happy on this journey, not just will I be happy at the destination? Because I can tell you, if you've had a bad time getting to the destination, it's probably going to be bittersweet.
Let's sort of look a bit further then in terms of.
Let's keep pumping through it, because there's a few things attached to that, right? So as I said, if you could work out how to get into the market before the boom, then that would be awesome, right? And that's kind of the thing. The secret really is to understand where and when to enter different markets. And it's no good just saying where, I don't know, Sydney's a good market, but the other key part of that is when. And so if we jump onto the next slide, Wishy. So often anyone who's heard me talk before, I talk a lot about the holy trinity of property, right? And when we talk about the holy trinity of property, we're talking about properties that are in high growth areas that are cash flow positive and with value add potential, right? But what we actually want to talk about today is what is the holy trinity of location selection, right?
And really, there are obviously a lot of different aspects to. There's a lot of science and stuff that goes into it, but it cooks down to some very simple characteristics: jobs, lifestyle, and affordability. Right? That particularly right now in today's housing market, they are the three things that are driving growth. Now, interesting look at Bondi Beach. Now, I live here, right? And I can tell you that there are no major new infrastructure projects. There is no new initiatives that are driving more jobs. It's got lifestyle, right? But it's not got the affordability. It's just jumped by 35%, right? And there's no fundamental change in the location. So what that says to me is that the boom isn't sustainable. Like specifically, the sharpness of the current boom isn't sustainable. Yep, the market is still going to go up over time, but that says to me it's more of an anomaly because you're not underpinned by fundamentals.
Yep. Good read.
So when we were talking about getting the where and the when on how to get into different markets, and Bushy, you touched on it a moment ago about the cycles, right? And so, as you said, if you can be in a market for 15 years at least, you're likely to pick up 2 cycles. Now, markets do move in cycles. The timing does differ, right? But anyone who thinks Sydney prices just only go up is sorely mistaken, right? Because they also go down and sideways and do all these other kind of things as well. So every single market in Australia goes through this cycle pattern. For those of you who are just listening and not watching this, we've got a graph on the screen which shows the average growth rate as a linear median, a straight line basically, but it also shows the cyclical nature of property prices relative to the average growth rate.
Just to verbally describe that, it looks like an S curve. So if you're listening to this, imagine an S curve where the bottom of that S is fairly flat for between 5 to 8 years on average. It varies by location. There's no set rule on this, but between 5 and 8 years. And then we see this sharp upward spike, which normally goes between sort of 3 to 5 years on average. And then it plateaus again and it goes through the flat desert stage, and then you'll see this spike in growth.
Exactly. The way that I explain it is that a lot of people talk about the property clock, and I know you do as well. But the thing about when people think about a clock is they think it's a circle, right? They think it goes up and down and round and round. It's actually more like a staircase, right? As you say, it goes a little flat, and then it goes up, and then it goes across, and then it goes up, and then it goes across. And look, the across often does have a little bit of a down dip as well, right? But the point is, you want to work out how to get in at the foot of the stair. Like how do you get in right before it starts to go up? So the interesting thing about that, just jump to the next slide as well, is that rents typically work in an antithetical phasing to property prices, because what tends to happen is that, as we talked about, jobs are one of the drivers, lifestyle, affordability. People will move to a location because they're attracted by jobs and opportunity and prosperity. They'll rent first because they haven't lived there before. They don't know where they want to live and what the good location is. Rents go up, rental demand increases. Then as rent increases start to go up too high, people start thinking, hang on a second, is it worth continuing to rent? Should I buy? And then they start buying houses. That pushes up property prices, etc. And so it's a virtuous cycle that feeds into itself. And so it ends up being like a bit of a snake that swims past itself over and over again. And so if you can get the timing right, which is on the next slide there, if you can get the timing right, you can actually target getting into the right markets at the right place at the right time to capture both a maximum rent cycle and also a pre-boom property cycle. And this is the secret, right? Because anyone who thinks that you can't time markets, I sort of say to them, well, just it doesn't matter. Just go buy anywhere then. Just doesn't matter. Just buy anything. Just buy anything and just whatever, move on. But if you're actually interested in trying to work out, okay, when and where and how can I make sure I'm not buying it in the wrong part in the cycle, there is a process to it. And we call this finding the Goldilocks Zone.
What advice do you have for somebody else who wants to, who's thinking about getting started or is maybe, wanting to achieve similar outcomes? Like what advice would you have for somebody else who is thinking about getting started?
Spend the time getting educated. I know a lot of people say that, but I think that is although I have to put a grain of salt on that, I will say I probably wouldn't have gone as hard if I knew things like I do today. I think there's a helpful amount of ignorance that will get you in the game. Yeah. But then past there, the education process makes it easier to navigate. So for anyone that wants to go the route we have with the pathways we have, you really have to understand it to avoid emotional points. Because we had many points where we got hit from the side or were challenged in ways we weren't expecting, and better education there from our point would have served us very, very well. So that would be my number one thing. And then the second one that I would say is that it is ignorant and foolish to think you can just do this on your own. Yeah. There are so many components and people who have specialized skills. Like I remember once, Goose, you showing me what goes into actually finding a location. And I remember just walking away from that going, wow, I'm just never going to do that. So I was like, okay. And then even to our broker, the same thing.
Yeah, 100%. 100%. Is there, I mean, I'm really impressed with you guys. Having not only had the opportunity to work with you, but also get to know you guys. Not a lot of people have the emotional fortitude, the financial acumen and stuff to be able to see this through. A lot of people sort of will find their own friction. And what I mean by that is, even though they can continue to move things forward, they'll choose not to just because it can feel a little bit it can feel quite daunting, you know. So it's no mean feat to do what you guys have done, and it does take. There's a huge mindset piece involved as well. It's not just like, hey, can you afford to do it? Great, just go and buy more properties. There's a massive mindset piece, and it's been really interesting to see you guys evolve, both of you, and you know, Bianca, you're taking this on and really starting to run it like a business as well, which is awesome. And seeing that development in both of you, I think, has been fantastic. But it's required that you've had to grow as individuals to be able to do that. And I think that's something that I've noted the most. What do you guys have anything to add to that?
It's really cool to hear that, I'll say.
Yeah, it's nice because when you're the one stuck in it, doing it and you know, dealing with the wins, but also the delays or the painful points along the way, it's hard to see that.
And I'm sure for everyone that does property, there's doubt moments, there's fear moments, there's greed moments. And I go through all of that. And at the end of the day, I'm probably thrilled we've taken the steps we have. Like, I like to think we've done it as smartly as we could. Some people may say otherwise, but I'm thrilled with the approach and I've been very happy with it.
In the spectrum of things, what's more important? In the spectrum of being able to continue to build your wealth over time, keep serviceability up, continue to buy more properties, get that critical mass, do all that kind of stuff. What's more important, cash flow or growth? I understand that growth ultimately will give you way more wealth, but at the same time, if you hit a barrier and if you had a choice between getting a property with a 6% yield and a 9% yield, and one got, 6%, one was 6% yield and 6% growth, and one was 9% yield and 4% growth, what would the choice be?
That's an awesome question, and I love it. So what my formula is accelerators plus accumulators plus lifestylers plus risk management equals an unbelievable life. And what I mean by that is you start with your accelerators, which are your cash flow positives. You need to build a base. If you start with your growth properties, you're going to have a whole heap of grief because you're not going to, and that's how I came up with what I did, because I only bought high growth, negative geared properties for a lot of years. And it caused me grief. I had tens of thousands, more than that, coming out of my pocket every year in negative gearing when the interest rates were 8%. It was a killer diller. And so that's why I decided to go off and start buying in America. And I bought heavily over there, and it turned out really, really well. And that was to offset my negative gearing in Australia. And then I took that concept into what I'm doing now. But so you need your cash flow positive properties to build a firm base. So you're not relying on your way because things can go wrong. Once you've got the firm base, you can afford to buy your growth property because it's going to cost you, let's say, $10,000 a year to keep it. You've got that money already because you've got this base of cash flow positives to afford, because you do need the growth to get to the critical mass of assets. But then once you've got this is my belief anyway, once you've got your cash flow positives, you get a 1 or 2 growth, you don't even need any more than that, then I would transition to what I call lifestylers, which are properties which are giving you extreme income. Yeah. So these are high end, and you've talked about, I think, as well. Like for me, that's things like, rooming houses, commercial.
Yeah. It's what we call legacy phase. It's any of those that have probably got commercial lending, huge amounts of cash flow, probably a little bit harder to leverage, a bit more complex, but ultimately total income replacement type stuff.
Like I'm doing one for a childcare centre. Yeah. You're getting $390,000 a year net income from the childcare centre.
What's the cost on that roughly?
5.5 mil. Yeah, but net cash flow, the way we've structured it, from day one, he's going to have $21,000 per month net cash flow.
Sounds rough.
Net. Yeah, it's pretty bad. Well, he's a doctor, so he got money. But look, there's things you get to at the end, but you need to set your base. Yeah. You can't start at the cream if you haven't got a foundation set up. You need that base to get you moving.
Yeah,
That's
totally.
why-
And that's
yeah,
exactly
that's
what.
my
And that's
thoughts.
exactly what. That's I believe 100%. I agree wholeheartedly. And we work through those 3 different phases as well.